large stakes in Meredith and Tanger factory outlet centres will likely have to be sold off by State Street's SPDR S&P Dividend ETF, ticker SDY. Now, this raises questions about the fund's construction. Here to discuss the fund and why it's dropping these two stocks, we've James Seyffart, Bloomberg Intelligence ETF analyst. So, James, why these two particular, Tanger and Meredith?
Yeah, so this fund, the S&P Dividend, the SPDR S&P Dividend ETF, SDY, as you said, it's one of the largest dividend ETFs on U.S. exchanges. But it's unique in the fact that it weights by dividend yield rather than market cap. So what happens here is the fund has been very in high demand because of the low rate environment. So it's grown to over $20 billion in AUM. And what it does, as I said, weights by dividend yield, but if the market cap has to be over $2 billion. But if that market cap falls below $1.5 billion, every year on the 31st of December, they decide to kick those stocks out. In this case, Tanger and Meredith are falling out of the fund as of the end of January, and they're pretty large positions.
Funds do this all the time. You see kind of ETFs having to do this on a regular basis. Why is this different?
Yeah, so this is extremely unique in the fact that of the sheer size, not in the absolute size. $557 million worth of stock isn't that big of a deal, especially in the ETF market, not even for a $20 billion fund. But what's unique is this size as a percentage of the company. So we're looking at Tanger, it's 22% of the shares outstanding that they have to dump, and you're looking at Meredith, it's 18% of the shares outstanding they have to dump. So this is a pretty unique situation, again, because of how big the position is, largely because of how big the fund is. Also complicating things is Tanger's short position. 58% of the shares are short. ETFs are often huge lenders of securities. And what we've seen is the short interest, the cost of borrow in Tanger spiked over 100% on January 10th, likely because State Street was calling this back.
Gosh, that's really, yeah, I mean, I'm sure they have a lot of problems then going on, but at the same time, was there any efforts to try and prevent this from happening? Yeah,
so there was an effort by S&P. They probably saw this coming. They issued what's called a consultation. Essentially is reaching out to the investment community, find out if they're contemplating making these changes. What do you think about these changes? And the changes would have done things like allow them to drop funds companies more frequently than once a year. And it also would have limited the size so they don't get to 22% of the shares outstanding. Actually, they decided not to make the changes, and even if they did, it probably wouldn't have affected anything. But what it really highlights is the unique situation of this fund. Basically, it weights on dividend yield. So as the price falls, if dividends stay the same, the fund is going to keep increasing its position in the underlying stock. But once that stock falls below a certain price, or in this case, market cap of $1.5 billion, then it's got to dump it. So it basically is building positions to be very large positions of the fund and then being forced to sell it.
Interesting construction, I would say. You talk about it being unique. Has anything like this ever happened before?
Yeah, so like I said, basically this fund got too large for its index, and something similar happened with VanEck Junior Gold Miners ETF. And what that does is invest in really small gold mining ETFs that have high beta to the price of gold. Essentially, small changes in the price of gold can turn these companies from being unprofitable to profitable. So traders love to use this. But this fund was very popular in 2017, went over $5 billion in AUM, and basically got too big for its underlying index, forced them to change the whole makeup of the index. It increased the maximum market cap from $1.6 billion to $2.9 billion, and all of a sudden the whole fund makeup has changed. The top 10 are no longer, seven new companies are in the top 10.